Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. David Bianco joins us right now. Good morning, sir. It's good to have you here. With DWS, it's like a Deutsche Bank wing, right?
Yeah, the asset management.
Yeah. What are you going to do June 30? What I see right now is a lot of window dressing. People are going, oops, I'm behind. I better buy some things. Is that what's going on right now?
Yeah, there's definitely been anxiety in the market, and to try to figure out a way to keep up with this market without being overly concentrated. Because
how do you do that?
Well, that's the challenge. The benchmarks have become concentrated, and we've got a relentless momentum market. The thing is, the fundamentals are good in terms of earnings growth at those stocks, those Magnificent 7, Grade 8. Maybe it's going to go from G8 to G10, G12. But, so much of the rest of the market has had really sluggish earnings growth, particularly sluggish real earnings. I think you'll see the same thing in 2Q results. Maybe a 3% growth at the S&P 492, but 10% growth with the benefit of the Grade 8.
Let's take out Magnificent 8, whatever they are.
Right.
And so there's another 480 stocks left. Let's take them down to 100 random stocks. How many of 100 of the rest of the S&P have earnings growth, have free cash flow growth?
The majority do have scant earnings and free cash flow growth. Not the healthy mid to upper single digit earnings growth you'd expect, particularly when you have had inflation and pricing power at companies as we have over the past couple of years. I'm not saying things are bad. I'm just saying earnings growth, particularly setting the Grade 8 aside, is not something that really justifies a 22, 23 PE multiple. Now, look, I do think that a 20-ish PE is sustainable as long as 10-year yields stay closer to 4 rather than 5, which is a risk, as long as the 10-year TIPS yield stays under 2, which it is right this moment. But I do think right now is a good time to de-risk and diversify. And I say de-risk because there's still a very good opportunity at 1, 2, 3 year points on the curve, and taking a little bit of credit risk, you'll make your 5%. And I'm doubtful that over the next 2.5 years, there's anything more than 5% total return upside annualized at the S&P. And for the summer, I think we're about to turn our attention even more to the elections. We've got the debate next week. We've got the conventions coming up. Obviously, the elections in November. What we'll hear more about is that fiscal policy needs to be addressed after this election. If it's not, and I think it'd be unwise for the Fed to cut before the election, not knowing the outcome. This is an important event, and it's very important for fiscal conditions and thus 10-year yields, and I don't think the Fed should cut before that.
So we're de-risking in part because some of the political uncertainty?
Exactly, and those who think the Fed's going to cut this summer or even in September, I don't think so. Those who think that there's going to be this broadening of health to healthy, strong earnings growth beyond the Magnificent 7, I don't think so, not yet, maybe next year. And these valuations, you go from 22.5 to 20 times this year's earnings is 4,900.
Okay, yeah.
And so you can easily have a 10 to 15% decline.
All right, so do we park ourselves in a 2-year treasury at 4.7%? Do we take any credit risk?
Not a bad idea to bad idea to overweight that. We're always in equities, but the preference now is for the shorter end of the curve and a little bit of credit risk. And then not that we have the ones we like and the ones we're concerned about when it comes to the Magnificent 7, but we are trying to diversify away from the Magnificent 7 because portfolios do benefit from diversification. You never know what's going to happen, and we're adding to the others, and we're adding to foreign equities, but we're not adding to small caps. We've gotten more cautious on small caps for the summer.
With Europe blowing up, and think yesterday, Adrian Wooldridge was great on London and the United Kingdom, and Leonard Laurent on France. What a half hour that was on these elections. Do you buy straw hats in winter, and that means you buy Europe blue chips?
Well, yes, I would stick with the larger cap blue chip companies in Europe. And while we do expect European earnings to get back to growth as soon as the second quarter and third quarter, and they've been in a profit recession for a long time. The thing about the European market is it's your typical or quintessential value investors market. And so as long as you think things are going to be okay politically or geopolitically and even economically, and we think things are improving on the earnings front out of Europe, as long as things are okay, and it's hard to crush the European economy. It's a resilient economy, albeit it doesn't grow strongly. As long as things are okay, the valuations provide upside, and we think Europe continues to generate strong returns, and it offers that diversification. We also like Japan, so I'd say IFA in general.
I mean, Paul,
Japan again. Coming out of nowhere.
Mr. Buffet is very big on it.
He is. He's very big. Again, kind of how I mentioned to Tom, I mean, we haven't talked about Japan for 25 or 30 years, and now it's almost every day I hear someone in your position say you're looking at Japan. What's really changed there?
Well, you've heard the governance story. They finally got religion on return on capital and corporate discipline, but they do have good businesses. Yeah. And finally, the banks are anticipating a higher interest rate environment, even a little bit higher than here. That will take time. But they have a lot of good industrial companies, machine tools and automation, and even components and materials that are important to semiconductors. The valuations are very reasonable. These are good businesses. It's a diversified index. The yen is really, really weak, and it makes Japanese products affordable. Also, it's under the U.S. security umbrella, which means that's the beachhead for investors into Asia.
Right. Let me swing it back to Europe. Siemens, which I haven't looked at in ages, been a moonshot off the pandemic. Folks, Siemens of Munich, 323,000 employees. Basically, it's ginormous. Dividend growth, single digit, it's there. But I'm sorry, with a limited capex, they got some serious free cash flow. And everybody's like beyond gloomy about the German manufacturing model.
And the German economy has been sluggish. And there are probably concerns to be had about auto, given the electric...
Yeah, but Siemens is not auto.
Exactly. So the thing about it is there are European companies that are very well positioned for the transition to electrification. Like the one you said, and I can think of a few others.
I can't talk about individuals.
I can, but the point is Europe is well positioned for electrification. I think that's known. Many of these industrial companies in the U.S. and Europe are doing well. But look at utility companies. That, I think, is an underappreciated play, not just on electric vehicles, but on data centers.
Paul, I haven't said this in ages. The forward multiple on Siemens, 16.
Yeah.
Remember that?
Yeah, it's been a while.
We used to go, I don't know, it's 12 multiple. I don't think they can span out to 16. And now what are we looking at?
But when I think of Siemens, and I think of the German economy, and I think of the export, and I think of the reliance upon China. Siemens, 12% of their revenue, thanks to the PGEO function on the Bloomberg terminal, 12% of their revenue is from China. That doesn't seem egregious to me. I mean, I guess that's a little bit of a discount in the multiple, but
it's amazing how that has become something that people take concern with and discount the multiple over the China exposure, the foreign exposure. It
used to be
the other way around. But electrification's alive and well. There are industrial companies, U.S. and Europe, exposed to it. The other thing that's going on in Europe, and maybe it comes, let's watch the elections in the United States, are carbon credits. And utility companies, electricity prices are going to be going up a lot. Unless the government figures out a way to help subsidize this, and carbon credits could help.
We got to run. David Bianco, thank you so much. Bulletproof engineering. Katy Kaminsky joins AlphaSimplex right now on Trench, Double E, and also, as Paul mentioned, operational research out of a school in the Charles River in Boston. Katy, we could go for 3 hours this morning, but just basically, have we reversed to finally trend in place, higher fixed income prices and lower?
In the process of pivoting, the signals have been switching more to long, particularly in international fixed income. But I'd say that you're still seeing a little bit of residual signal short in fixed income for the U.S. because of the recent moves. not being enough relative to long-term trends. So it definitely feels like an inflection point this month.
The general rule I get, thanks to Zero Hedge for great work on this every week, is on a Friday they sort of assess the bet that's out there. It seems to me that retail is betting America, big cap, large cap, NVIDIA, blah, blah, blah. And hedge funds are maybe not on that page. They're on a different page. What is the bet right now that you observe in the CTA community?
So right now, it's been interesting because this year, most of the year, it's been a hedged bet in the sense that you've seen long equity signals. That's been one of the best momentum plays this year till now. But you've also seen some changes in the commodity sector. So the copper trade, the positioning in gold, a lot of commodities has been long, but has been dissipating. And then this month, you've seen suddenly now energy is moving upwards again. So there's this disjoint in the commodity sector. Fixed income has been short most of the year, except for now recently, you're starting to see that pivot. The US dollar, again, a tricky one, has now been rallying again. We can talk about that. But in general, it does feel a little bit like a pivot or an inflection for current trends into what could be the trend going in the second half of the year.
So, I mean, broadly speaking, Katy, the folks you talk to, is it a risk-on environment? Do I want to be long stocks, bonds, things like that? Or are people just too concerned here about where the global economy is going?
So this is a very good question because before June, my answer would be, yeah, it's pretty risk on with the exception of short fixed income positioning. But this month, we have seen several synchronous sell-off periods for some of the prevailing trends. And we've seen some consistent risk-off days, meaning that people are running to bonds when things are looking bad. And I think this is an indication that they're actually starting to get concerned about some of the weaker data, particularly on the economic side. And so to me, it feels like sentiment has shifted some in the markets, and the signals are adjusting to that.
So in the fixed income market, Katy, do you want to just, I don't know, sit in a 2-year treasury and get close to 5% yield, or do you want to take some credit risk on here? And if so, where?
Oh, that's a good question. I mean, I think a lot of, in terms of the credit space, is not something we are focused on, but what you have seen is that, you know, there is this trade-off between locking in that higher yield if you do think that rates are going to come down. So I think a lot of investors are also considering that, like, could this be the moment if things do calm down? And so if you're seeing a significant enough spread in a credit product, that may make sense. But of course, there's always this issue that if we do actually see a longer time to get lower rates, there's substantial volatility around the bond positioning in general right now.
Should we go double E on her?
Sure.
Okay. Ladies and gentlemen, for the first time ever on Bloomberg Surveillance, Brownian motion and drift function with Katy Kaminsky. Katy, I look at BitDog and I can't find a legitimate time series. This is Hamilton, folks, out of University of California, San Diego. It doesn't drift within a random sense like most time series. Can you get actual time series motion out of Bitcoin?
Well, I mean, I think so, because Bitcoin just has way more volatility. So I think you just got to have a different input function to that drift process. And notoriously, it's difficult to estimate the mean of a Brownian motion. It's easier to estimate the vol. So I'd say that, you know, you can definitely be sure that you're going to have much higher volatility in those type of assets.
Right.
Not to mention the fact we don't have as much data that haven't been around.
Exactly. Is it maturing though? And on the Kaminsky MIT timeline, when does Bitcoin start to drift like Microsoft or Sweeney Amalgamated, the metal company out in New Jersey?
Well, I think that's what, you know, initially people like to think that something is so different, and it's not, it's different from everything else. And I think that Bitcoin has really shown as an asset, it's just a highly volatile asset, but it does have drift and it does behave in some sense less like a, you know, risk off asset,
Right.
less uncorrelated to stock markets than anything else. So people thought, oh, this is totally different. It's an uncorrelated process, but It actually does have a lot of inputs to people's demand because who's buying it? People need to buy it, therefore it's still connected to the general economy.
Was this too much for Friday?
Way too much for a
Too
summer
much.
Friday.
Katy Kaminsky, go away. With AlphaSimplex there, a Brownie in Motion, and BitDog. I love that. I mean, frame that right there. Katy Kaminsky, just truly outstanding. This is a wonderful conversation now. And we pause, and I'm going to do my annual lecture. It's summer. You have kids at home. They're in high school. They're bored. They're in college. They're bored. They're out of college. They're bored. You start screaming, Daniel Kurtz-Phelan, and you throw a subscription to Foreign Affairs magazine at them and say they don't get lunch money for the next gin and tonic until they read 2 articles. Joining us from Foreign Affairs, always my read of the summer, Daniel Kurtz-Phelan. Daniel, congratulations on the issue, and you brilliantly frame out Biden and Trump foreign policy with Ben Rhodes and O'Brien of the Trump administration. Tell me the distance between those 2 articles.
Yeah, thanks, Tom, first of all, for the new marketing pitch. I'll send that over to our business side and see what they think. I mean, I think that there are a lot of fascinating things as you read through these 2 articles. You have, I think, Robert O'Brien, who was the last national security advisor in the Trump administration, laying out probably in more detail and more specificity than we've seen from anyone in the Trump camp what a second Trump term would do. And then Ben Rhodes, who was one of the most senior foreign policy advisors to Obama, kind of laying out, I think, a slight difference from the Biden administration, but broadly sympathetic to the administration. And what's kind of fascinating about both of them is they both are kind of reacting to a sense of failures of American foreign policy in preceding decades, though they go in slightly different directions. Brian, some of the hawkish impulses that you get from Trump at a very high level, in a kind of very abstract way in some sense, with a lot of specificity. So he talks about going back to testing nuclear weapons, something we haven't done actively in a long time, full decoupling with China, and really ramping up pressure there.
Okay, but that's where I wanted to go. Daniel, your claim is still will onto Marshall and our distance from China, and I'm going to say 1948. Nothing's changed, right? These 2 candidates really want a distance from China, right?
That's exactly right. And just to flag one other thing in the issue, Tom, we had talked in the past about an essay we ran by Matt Pottinger, who was the kind of chief China hand in the Trump administration, and Matt Gallagher, former Republican congressman who ran the China subcommittee, laying out a really hardline strategy against China that called for really weakening the Chinese Communist Party. Its regime change has become a dirty word because of its association with Iraq and American foreign policy, but they call for trying to change the nature of power in China. And there's an exchange between Pottinger and Gallagher on the one hand with Rush Doshi, who just left the Biden administration working on China policy. What's really amazing is how much agreement there is. So they split on that question of weakening the regime, but there's a lot more agreement than disagreement, which I think reflects where we are on the China debate.
Daniel, if you're President Biden, you're obviously election year. What are the to-do list for President Biden here in an election year from a geopolitical perspective? You've got China, you've got obviously the Middle East, and you've got Ukraine. What's the strategy here, do you think?
Yeah, I mean, it's not a moment where you envy people kind of sitting in the U.S. government trying to manage these 3 crises. I think what they're trying to do on China, which remains, as we've talked about in the past, the kind of framing the dominant issue for American foreign policy, even with other crises and hot wars going on. I think on China, there's this desire to just keep it as calm as possible through November. So Xi Jinping and Joe Biden met in San Francisco in California last November. And it's not that they settled any of the really deep fissures and tensions in the relationship, but they did basically say, look, let's calm this right now. We both have reasons for doing it. The Chinese economy, as you all know extremely well, is in terrible shape. So there's a mutual interest in not stirring the pot too much at this moment, but it doesn't really solve any of the basic issues. So I think Biden would like to keep that at a low boil, even as he finds some way to get through what are still these kind of, frozen, terrible status quos in both Gaza and Ukraine. So the Hail Mary in Gaza is, of course, a Saudi normalization deal that they're still pursuing really aggressively, which, what the odds of that are, it's really hard to say. It seems like a long shot to me, but it would really be transformative. Similarly in Ukraine, hoping that the battlefield shifts a bit and things don't look quite as grim as they do right now.
Got to leave it there. Daniel Kurtz-Phelan, thank you so much with Foreign Affairs. I can't say enough about it, folks. Lisa, what do you have?
All right, what we're talking about missing out on that NVIDIA stock, right? The big...
Yeah, tell me.
So SoftBank CEO Masayoshi Son, he's known for some of the most successful investments in technology history, but he made that mistake, okay? At the company's shareholder meeting, he's talked about missing out on $150 billion after selling NVIDIA shares in 2019. Okay, so you have the breakdown. It was SoftBank's Vision Fund. They sold an entire 4.9 stake in NVIDIA. They booked a $3.3 billion return on the investment, so it seemed like a good thing because they spent about $700 million for the stake. But if he had held on to that NVIDIA stake, it would be worth around $160 billion today.
There will be a biography. Lionel Barber, who's rode the FT for years, Lionel Barber, out with a one volume, I think it's the beginning of the year, Gambling Man, The Secret Story of Masayoshi Son. I don't have a really informed opinion.
Some big winners and some big losers.
That's collegial. You nailed that.
A big stake in ARM and Alibaba, so that's not too bad.
Okay, what else next?
But he missed the train. Okay, Taylor Swift economy has landed in Europe, Tom. Yes. The European summer tour has kicked off today. Actually, she's performing the first of 8 shows at London's Wembley Stadium. 700,000 people. 8
shows at Wembley. Holy
700,000 people expected to see that show.
Are they all Americans?
So that's the thing. A lot of Americans flying in, spending money. Airport, hotels, restaurants, you name it. Spending money down there.
All right.
So
there's a photo there. Mohammed's sitting next to Stephanie Rule of MSNBC.
I saw that.
I'm like, what is this like? Exactly. Liz Ann Saunders is like 3 rows over. Come on, continue.
But they're saying it could put a strain on inflation because when she comes in, everybody raises the prices, and for the hotels and for the restaurants, everything.
The economic input has got to be just extraordinary.
It keeps going.
It is just, I haven't seen anything like it. Again, it feels, Tom, and I'll defer to you, it feels like Beatlemania, just that whole, I haven't felt anything or sensed anything like since Beatlemania.
Yeah, I'll go with that. I'll go with that. I will say, there's a lot of talk about she's put out too much product, and the new album just is not the magic that we saw with Antonoff and the National in the pandemic. And, there's an ebb and flow that happens to any artist.
Right.
And I'm going to cut her some major slack on that. But is there an opening act?
That's a good question. I don't know.
I don't know.
That would be a good gig, though.
That would be a good gig.
That's getting you some notoriety there.
Next.
Okay, this one. Okay. It turns out men aren't the only one to benefit from Viagra. A lot of doctors prescribing it for women.
What?
Okay, this is in the New York Times.
What's Viagra?
I'm treading very carefully here, okay? But there's a lot of research. It shows how the drugs affect female arousal. It's limited. There's not much research on it, okay? But the doctor's been prescribing these pills and creams anyway. Telehealth companies are coming out with them. Pharmaceutical companies looking for FDA approval for different kinds to market specifically to women. Is it worth it, though? Okay, so the experts are saying, stick with me here, physical arousal in women similar to erectile dysfunction because it has to do with blood flow. Okay, that's as far as I'm going. But it's not a solution for everybody. There it is. It's out there. Studies show mixed results. Either way, the doctors are prescribing it for women.
Why not?
There you go. I'm telling you, the New York Times has it there.
All right, we'll go with it. If it's good for men, why not?
That's borderline. I don't know if we can say all that.
But we did. So
Next.
There you go. Okay, since we're heating things up, all right, so finally the new Bugatti. It's the hybrid. It has a powerful price tag, $4.1 million.
For a car.
Yes, it is called the tourbillon, okay, because it is the French word for whirlwind. You get a lot with it. You get the V16 powertrain, 2 electric motors, one in the front, one by the rear axle, 1,800 horsepower hybrid power plant, speeds of 276 miles per hour. You have to check it on the terminal. It's a great article. The pictures are amazing.
What's amazing?
I mean, Matt Miller's going to pull up on one of those any day now. I know.
can totally see him.
Katy Kaminsky's getting ready to come on here, and she's setting up. You're talking about the damn Bugatti. She's such a hitter. She's taking notes. She's going to be down at the local Bugatti dealer in Cambridge, Mass.
Checking it out.
I tell you, it looks like a spaceship.
And here's the best part about it. It has this screen that pops out of the center, and guess what that screen has on it? Apple CarPlay. Bam.
Are you kidding? Apple CarPlay's in the Bugatti. We love the Bugatti. All I can say, folks, that we get the numbers. We are humbled worldwide by what Apple CarPlay has done. Just no question about it. Is that the last one, or would you like to go back to medicine?
No.
This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.